Okay, so you know those notes you sent over on the Intelligent Investor? We're going to like really break those down today. Think of it as like a crash course in Benjamin Graham's ideas for making really smart, investment moves. We're talking minimizing risk, but still going for solid long-term growth. That's the whole goal here.
Yeah, and I think what we've pulled out from those highlights you gave us is how to get to the core of Graham's philosophy. And the big takeaway is the difference, the fundamental difference between what is real investing and what's just, well, speculation.
And understanding that is like step one.
Mm-mm.
It's huge. So Graham, at least according to what we're looking at here, he defines investing as something that, after you've done your homework, you've analyzed everything, it should promise you a couple things. Safety, meaning you're not going to lose your initial investment, and a decent return on top of that.
Right. And speculation, on the other hand, that's more about trying to, catch those quick market waves, those short-term jumps, without really doing the deep analysis or worrying too much about whether you're going to get your money back.
And Graham, he was pretty adamant about that.
Yeah.
He was like, stay away from speculation. It's so tempting, right, to
Yeah.
try and get rich quick. But his whole philosophy is built on the idea that you build wealth, real wealth, by being disciplined, doing your research, and thinking long term.
Absolutely. So for everyone listening, think about your own financial approach. Where do you fall on that spectrum? Are you basing your decisions on careful analysis, that long-term view? Or are you more tempted to kind of jump in and out, try to time the market?
Right, right. And to really wrap our heads around this, because the market can be kind of crazy, Graham has this amazing analogy. He calls it Mr. Market.
Oh, yeah. This is one of the best ways to picture how the market actually works, with all its ups and downs.
So picture this, right?
Yeah.
You have a business partner. His name is, well, Mr. Market. And every single day, this guy shows up at your door. And he's either trying to buy your part of the business or he's trying to sell you his.
But here's the thing. Mr. Market, he's emotional. Some days he's super optimistic, over the top excited, offering you these crazy high prices. But then other days he's totally down in the dumps, practically giving his shares away.
And the point Graham is making here,
Yeah.
and this is key, is that we should look at all this craziness as an opportunity.
Yeah.
You don't have to play Mr. Market's game every single day. You can just sit back, watch his mood swings,
Yeah.
and only make a move when his prices actually make sense, when they match what you think the business is actually worth.
It's so important to remember that, people are behind these market swings. And people, well, we're not always rational, are we?
Nope, definitely not. Which brings us to another big idea from Graham. It's what he calls the margin of safety. It sounds kind of technical, but it's really a pretty straightforward concept.
It is. Think of it like this. The margin of safety is basically the gap between what you figure a stock is really worth, like its true value, Graham calls this intrinsic value, and the price you end up paying for it on the market. Imagine you're at a store, right? And you find something you really want, but it's on sale, a huge discount.
That discount, that's your margin of safety.
Exactly.
Yeah.
It's a buffer. So let's say you do your research and figure out that a company's stock, it's actually worth, say, $100 a share. But Mr. Market, he's having a bad day, so he's only offering it for $70.
That $30 difference, that's your cushion.
Yeah, you're buying below what you believe it's really worth, so it reduces your risk. Even if you weren't 100% accurate with your analysis, you've got that buffer. Plus, it means your potential return is even higher because there's more room for the price to go up and reach its real value. Now, figuring out that intrinsic value, that can be tricky, but Graham's all about using different tools, being careful with your estimates so you can build that safety net in.
And Graham, he knew not everyone has the same, time or even interest to do that deep analysis. So he outlined two main types of investors: the defensive investor and the enterprising investor. As you're listening, think about which one sounds more like you.
So the defensive investor, their top priority is keeping things simple and low risk. They're not necessarily gunning for the highest returns. They want steady growth over time without having to constantly manage their investments.
And Graham had a pretty simple approach for them, right? Build a diverse portfolio, invest in safe, low-cost options. He even gave some guidance on how to, split up your investments.
Yeah, he recommended keeping, say, 50% to 75% in bonds. Those are generally less volatile, and then the rest, 25% to 50% in stocks for growth potential. He was all about investing in big, solid companies with a proven track record of making money.
And he had this great tip that's super practical, especially for the defensive investor. It's called dollar cost averaging. Can you explain that?
Sure. Dollar cost averaging takes the emotion out of it. You basically invest a set amount of money at regular intervals, like every month or every 3 months. You do this regardless of what the market's doing.
So you're not trying to guess when the market's going to go up or down.
Exactly. Which, let's face it, is really hard to do consistently. And over time, what happens is you end up buying more shares when the prices are low and fewer when they're high. So your average cost per share ends up being lower than if you tried to, time the market perfectly.
Makes sense. So let's switch gears and talk about the other type, the enterprising investor. This is someone who's willing to put in the time, do the research, dig deep into companies. They're okay with a little more risk, hoping for higher returns.
But, and this is super important, it's still calculated risk. The enterprising investor isn't just gambling. They're using Graham's principles, looking for companies with strong financials that the market might be, overlooking or undervaluing at that moment.
So the defensive investor might go for broad market exposure with index funds. But the enterprising investor, they're actively hunting for those, hidden gems. Think about which one sounds more like you, your personality, how much time you have, your comfort level with risk.
And this takes us back to those market ups and downs we talked about earlier, the Mr. Market thing. This applies to both types of investors, really.
Totally. Whether you're defensive or enterprising, Graham's point is, don't freak out when the market dips. Instead, think of it as a potential sale. When the market drops, you might be able to snag some good deals on companies that are actually, strong companies you've already researched.
Yeah, because the short-term price swings, they're often driven by, panic or excitement, and they don't always reflect what's really happening with the company itself. The smart investor sees through that, doesn't let those temporary swings mess with their long-term strategy. They know the difference between the price tag and what something is really worth.
Okay, so for those who are leaning towards that, enterprising approach, the ones willing to dig in and do the research, what did Graham actually say to look for when picking stocks? What makes a good company in his book?
He had a bunch of criteria, but first and foremost, a company needs a strong financial foundation. Look for companies that don't have a ton of debt and they have a good current ratio.
Current ratio.
It's just a fancy way of saying, can the company pay its bills? Can it cover its short-term expenses with the assets it has on hand? A good ratio means they're in good shape, financially speaking.
So basically, you want to invest in companies that aren't drowning in debt and can actually pay their bills. Makes sense. What else did Graham say to watch out for?
A long history of earning money, ideally for at least 10 years. This shows they're stable, they've weathered different economic storms, and consistently paying dividends is a good sign too. It means they're sharing their profits with shareholders.
Right, right. And then there are those financial ratios that help you figure out if a stock is like a bargain.
Yeah, those valuation metrics. So Graham was big on the PE ratio, which compares the stock price to the company's earnings. He liked companies with PE ratios that weren't too high, because a really high PE could mean the stock is overpriced. He also looked at the PB ratio, which compares the market value of a company to its book value. That's basically what the company's assets are worth minus its debts. A lower PB could mean the market is underestimating the company's true worth.
Okay, so those are some of the nuts and bolts of stock picking, Graham style. But no matter what kind of investor you are, defensive or enterprising, Graham had one piece of advice for everyone: diversify. Why was that so important to him?
Diversification is like your safety net. By spreading your investments across, say, 10 to 30 different stocks, and ideally in different industries, you're protecting yourself. If one of your picks tanks, it won't sink your whole portfolio.
So you're not putting all your eggs in one basket.
Exactly. Now, on the flip side, Graham was also pretty cautious about certain types of investments that might seem tempting, but they can be super risky. He was talking about IPOs, those initial public offerings when a company first goes public, and high-growth stocks with really high PE ratios.
Why was he wary of those?
He felt like those investments are often driven by hype, that buzz around a hot new company or industry. But there's not a lot of solid data to back it up, no long track record to show they can actually make money consistently. So the risk of overpaying for those stocks is much higher. He preferred sticking to established companies with a history you can actually analyze.
Okay, so let's bring it all home for our listeners. Let's talk about how they can actually use Graham's ideas today in the current market. We'll start with the defensive investors. What would you suggest?
Well, for someone who wants to keep things simple and low risk, a good option could be investing in those low-cost index funds we mentioned earlier. The ones that track the S&P 500 or a similar broad market index, instant diversification across a bunch of companies. Or they could go for a portfolio of those blue chip stocks, those big, solid companies we talked about. The key is to figure out the right mix of stocks and bonds for their risk tolerance, and then rebalance every so often to make sure they're still on track.
What about the enterprising investors out there, the ones who are ready to roll up their sleeves and do some research? What should they be doing?
They're going to be digging into those financial statements, looking for companies that meet all of Graham's criteria. Low debt, steady earnings, consistent dividends, and those PE and PD ratios that suggest the stock is undervalued. The most important thing is to find companies where there's a big margin of safety, meaning the market price is much lower than what you think the company is actually worth. But even as an enterprising investor, you got to avoid those short-term bets, the speculation. The focus is still on the long game, the fundamentals of the business.
So to wrap this all up, what would you say is the biggest takeaway for our listeners today? What's the one thing they should really remember from Graham's work?
I think it's about being a rational, disciplined investor. It's about tuning out all that noise and emotion that the market throws at you and instead focusing on analyzing the facts, making decisions based on logic, and building wealth slowly and steadily over the long term. Using those key principles we talked about today: margin of safety, diversification, and really knowing what kind of investor you are.
That's a great summary. And before we go, here's a final thought for everyone to chew on. How can the things we talked about today change the way you see the market? How you make your own financial decisions? Think about that difference between price and value, not just in the stock market, but in life in general. How can that help you make smarter choices? Thanks for joining us on this deep dive.